Good evening, everyone, and thank you so much for coming to this webinar on Cheslyn Place in Spartanburg, South Carolina. We're really excited about this opportunity. It's just an amazing property that we're very lucky to be a part of, and excited to get right into the presentation. So first thing that we got to do is a disclaimer. Most people know that this deal is only open to accredited investors. It's under Regulation 506C, under Reg D, and that means that we can only accept accredited investors. If you aren't sure if you're accredited or not, please feel free to reach out to myself, Sujatha from Luxe Capital Investment Group, and we can get that sorted out. If you haven't submitted an investor accreditation with me, then previously, then we'll need to do that before you can invest in this deal. Also, as always, this is not a offering of securities. This is purely for educational purposes. And as with all deals, we encourage everybody to please do your own due diligence and research. Okay, now to dive into the exciting stuff, we got the deal coming up. So Cheslyn Place, this is a newly constructed build to rent community. What is build to rent? If you're not familiar with it, it's when single family homes are built and then rented. And so whole communities are built. In this case, we've got 49 duplexes, which is equal to 98 single family homes. They're all an ideal mix of bedrooms and baths at 3 bedrooms and 2.5 baths. They all have a 1-car garage, which is another incredibly desirable amenity. And one of the things that I love about build to rent is that these are brand new properties that have been designed with all of the modern amenities and modern design principles built into the units themselves. And so whenever somebody's looking and comparing, do I want to live here or do I want to live there? The properties in our build to rent community are going to always be a cut above the rest because they're incorporating these modern design elements. Another great thing about this particular opportunity is the location. It's located in Spartanburg, which is just 15 minutes from downtown Spartanburg. And we're going to get more into the details of the location with our operator, who's we have Hemel on the call today, and he's going to be describing why this market is so attractive for this particular unit type. Okay. So just to review some of the basics, this is a low risk asset. So whenever you build new construction, there's often a 10-year warranty. So on many different pieces of the property. So whenever you have new construction, there's going to be lower maintenance costs for the first 5 or 10 years, which is just really helpful for lowering the risk of the property and the operations. Additionally, this property is already stabilized. It's already 95 to 99% occupied, which is just a very attractive place to buy a property from a risk-adjusted standpoint because it's already leased up and cash flowing from day one. Again, it's an extremely desirable location next to 2 interstate highways that just are in an area of South Carolina that is just booming right now. And we'll go into the specifics of that very soon, but there's a lot of job growth. There's a lot of manufacturing development that's happening there in that area. And in addition to, so our business plan is actually a fairly straightforward business plan, which is a really awesome place to be. What we're going to be doing is bringing rents to market. So currently there are concessionary rents because the developer, so this property was built in 2022. We're buying it brand new. The developer started leasing out properties in July, and they lease up properties at a very low rate, and they started increasing it slowly over the last several months. So one major piece of our business is really bringing the apartment rents up to market rate. We're also going to be beautifying the property and adding some ancillary income and optimizing the property for operations, which we'll go into later. Again, we've got great tax benefits with this deal. we're going to be taking advantage of 100% bonus depreciation, which is available this year. It's not going to be available next year. So some details of the deal. Purchase price is $24 million. We're going to be raising about $11 million, which includes the CapEx that we're going to be doing, which is a relatively small amount, closing costs, reserves, so that the deal is well capitalized. And that is our total equity raise will be about $11 million. We are buying this property for about $244,000 per unit. So this is a really good basis, because to construct the same type of units today, we would be well north of around $200,000, and it would take 2 years. So we're able to buy this property at a very, very strong basis. Again, part of our business plan is increasing rents to market rate, which is a fairly simple process. As a lease ends, we can increase the rent, and we'll be doing that over the next 2 years. So the business plan is going to take place over the next 18 to 22 months or so, and our plan is to increase rents to $19.95. Now, one thing that's great about this is that our comps are currently showing that we can rent these units at $19.95. So when we talk about executing our business plan over the next 18 to 20 months, we're really just talking about underwriting rents to what the market is doing today, and we're not taking into account any upward pressure on rents over the next 2 to 3 years. So that's a very conservative standpoint. And what does that get our investors? So it gets an average of 5 to 7% cash on cash return, average return, annual return of 20 to 22%. We're hoping to hold this deal for 3 years, but we may hold it for longer if that's needed based on macroeconomic conditions. And that's equivalent to a 17 to 19% internal rate of return, which is really a very attractive rate of return, especially when considering the conservative underwriting that we've done. So here's a quick overview of the project timeline. The purchase and sales agreement was executed on September 27th. Our lead sponsor, Exponential Equity, completed their due diligence by October 14th, and everything looked very good. We are going to have subscription documents available sometime shortly in the next week or so, and the funding deadline is going to be December 13th. And I'm now going to introduce Hemel Badiani and ask him, Hemel, will you please talk about why this is such an exciting market to be in?
Yeah, thank you, Sujata. I'm glad to be here and excited to talk about this market. So if you go to the next slide, just to give everyone the context of general macroeconomics, right? As everyone knows, the pendulum has swung from globalization to more local manufacturing and industrial growth. And strategically, the United States has a lot of pockets where this growth and the supply chain is being developed. And one of those areas is this Interstate 85 corridor that goes from Greenville, South Carolina, well, Atlanta in the south, but mainly from Greenville, South Carolina to Greensboro, North Carolina, with Charlotte MSA in the middle. And that 3-4 hour territory is where the lanes are being expanded, a lot of manufacturing facilities and companies are coming in, and just creates jobs galore. So this will be in the heart of that growth area that has been experienced in the last couple of years, but also continuing to get experienced. And then the last thing is the Spartanburg MSA is really 2 cities, Greenville and Spartanburg. Greenville experienced the bigger growth, and now it's slowly moving to Spartanburg. So again, prices are not as high as one would expect in Greenville or Charlotte, but definitely would get there. So this would be the right time to purchase. Go to the next slide. Yep, jobs galore. So you'll see, any big company. I'll tell you the biggest news last month came out on October 20th. BMW actually has a $170 million plant here already, manufacturing plant, and they're pouring in another $1.7 billion to build the largest electric manufacturing unit in the world for them. and also their concurrent battery operations and battery manufacturing for those electric vehicles. So they're putting out 6 different models in the market and going very aggressive in the electric vehicle space. And Spartanburg County is at the heart of it, which is the BMW plant is 3 to 5 miles away from this asset. But yep, there you go. That's one that's already there for a couple of $100 million. It's going to get tenfold that, which is super exciting as a job prospect. But Paul Corporation, there's a lot of defense jobs. Oshkosh, because the Oshkosh Defense is here. We have Walmart's fulfillment center is here. And then what else? Yep, Nestle is here. So yeah, exciting time. If you look at the upstate South Carolina Alliance job market, they have created in just the last 2 years 20,000 plus jobs, and that allowed with a $6 billion investment. And I think this would continue to grow at a rapid pace. And what do all these jobs need? It's families moving here. It's families looking to a place to buy or rent, and that's what we're going on with this community. On to you, Sujata.
Okay, great. Thanks, Hemal, for the market overview. So why do we love this property? It is a fantastic unit mix. So all the units are 3 bedrooms, 2.5 baths. They're all a really nice size at about 1,366 square feet. The average rent per square foot is very achievable for the market area. And it's built in 2022. So again, it's a new construction, which is going to make it very easy to operate and make it very attractive for potential renters. And again, one of the reasons why build to rent is so exciting is because a lot of folks are getting priced out of buying homes. And while that is definitely a problem that needs to be solved for investors like ourselves who are looking to invest, there's going to be a high demand for tenants who are wanting to rent single family homes. And single family homes like ours have, again, the sleek finishes and the modern layouts and all of the amenities that most people want. Single family car garage, a dog park, a walking track, package facilities, other community assets, playgrounds, and are just a very attractive place to live if you're a growing family. Additionally, all the residents are paying for all of the utilities, which also makes it easier for a landlord to manage expenses. So here's this map. Hemal already touched on the location, but just to review some other aspects of the location that are really attractive. Here you can see how Cheslyn Place, which is right here, is situated very close to the intersection of 26 and 85, which are 2 major highways that connect Greenville and Spartanburg. And within a 15-minute drive, you can get to so many different employment centers and other amenities that people will want to be in. And so it's very well located. It's just in a really excellent area where, again, people are moving to this to Spartanburg, and people are moving to South Carolina. It's a market that I've wanted to be investing in a long time, and this is the first time Luxe Capital is investing in the Carolinas, and to be in a build to rent asset in this particular market, which is so well located, is really exciting. So here's an aerial overview of the property. You can see there's 2 cul-de-sacs. So these cul-de-sacs have slightly larger yards and command slightly larger rents. Folks can enter through here, and you've got just a typical build to rent sort of design where there are houses across the street from each other. Here's the walking track. Here's the playground. There's a mailbox area. And again, there's these larger units over here with larger yards, etc. So there's also a covered outdoor patio, which is very nice for year-round recreation. And so that's a general overview. Of course, part of what we're going to be doing is beautifying the property. So this is obviously taken during construction. And in addition to what the developer is doing, we're going to be further beautifying the property with updated landscaping, privacy fencing, and exterior lighting. And okay, so as far as inside the unit, so what do they consist of? Well, as you can see, they're all very modern, and they're oftentimes when we're buying multifamily properties, we're buying older assets, which we improve. And so we're often updating those kitchens and bathrooms, and we're doing a great job of taking those older assets and making them nice. What's great about this is you can tell from just being inside it that it's new. And so that's going to be attractive to lots of potential tenants, and will just continue to drive occupancy and rents at the property. So we've got this classic black and white, which is very on trend right now in terms of the trim and the paint. Granite countertops, central AC and heating, which is very much needed. As far as amenities, people really appreciate that. Brand new appliances, basic lawn care is provided, so the community will continue to look neat, and we don't have to rely on tenants, and they don't have to worry about that. Again, a single car garage, garbage disposal, subway tile backsplash. Our tenants will have both a front and back porch. They have walk-in closets, so there's a lot of storage built into these units. And we've also got dual vanities in the master bathroom, laundry room, and washer dryer hookups. I'm just going to take a minute to ask everybody to mute, please, just so that we don't have any background noise. Thank you very much. So here's some more images of the property. We've got this garage. So this is how the garages look. Again, very, very modern style, which is attractive to folks. And this open style floor plan where the kitchen has an island and it leads into the living room. And let's go into a little bit more detail on the business plan. So as we've already mentioned, we're going to be increasing rents to market. Some of the leases are at $13.95, some are at $14.95, $15.95, $16.95. We're going to be able to increase those over the next 2 summers. We'll be incrementally increasing them with the plan of being at $19.95 by like our numbers are based on $19.95 rent over the next 2 to 3 years. However, we think that we can increase rents more than $19.95 based on the comps in the area currently. Number 2, we're going to add ancillary income. So if you've ever heard me talk about the value of $1 when it comes to net operating income, this is why ancillary income is so exciting, because when you add $1 of income per unit to the net operating income, that increases the value by a factor of 20. So if you were to add $1 of rent to every unit, that's 98 units, that's $100 a month, and approximately $100 a month times 12 months is $1,200 a year, and you divide that by 5%, and that's tens of thousands of dollars just by increasing the rent by $1 per unit. We're increasing the value of the property by so much more. And that's one of the reasons why we love commercial real estate so much, because it's based on valuing an income stream. So we're going to be adding ancillary income such as administrative fees and pet fees for our tenants that want to have pets with them. And again, even those incremental, and we can do valet trash, and we'll be continually looking for opportunities to optimize the net operating income with ancillary income. We're also going to spend the CapEx dollars that we have to finish really making the exterior of the property just shine. And we're going to add privacy fencing so that our tenants that either want privacy or want fences for their dogs can have that. We'll add extra privacy patios and make sure that the lighting is up to our standards. And number 4, we're going to maintain stabilization. So by simply keeping the occupancy over 90% while pushing rents, we can optimize for our NOI and move towards that pro forma rents that we're looking for in a conservative way. All right, I'll pass it back to Hemel to look at the returns and financial. Oh, wait, actually, I'm going to do this part. So here we have what we believe to be what we're currently projecting for the schedule. So we're currently looking to do a majority of lease upgrades in April 2023, through July. So these are the months when a lot of leases will be renewing. And that means that at that time, we can start increasing the rents on those leases. So we'll be doing that in this summer of 2023 and in the summer of 2024. So we don't want to take a unit that's at $13.95 and take it all the way to $19.95 in 1 year if the tenant wants to stay. So we'll do it in 2 years. And so that gives you an idea of the timeline. And again, the average rent right now is around $1,500. We're going to take it to about $2,000. That's an average of a 32% increase in rents over the course of the next 2 to 3 years for our pro forma rents. And again, we believe that is very achievable because it's one, we've already achieved rents of $1,885 at the property. The developer has tested rents at $1,885 and they've rented units at $1,885. So within the next 3 years, we don't see it as any issue at all to really bring all of the units up to $1,995. And here's some idea of some of the rent comps. So, got to always look at the rent comps to see how our pro forma rents are comparing to what's already happening in the market. So again, as is, when you look at the average rents across Cheslyn Place, we're at $1,695. Here is our pro forma rents at $1,995. All of these other developments are already above Cheslyn Place. So, some of them are built around the same time period. This one was built actually in 2015. Of course, it's maybe a little bit larger, but when you look at all of these on as a set, you can see that 1995 is really not very far off from what's actually happening in the market. And that's why we feel very good about the conservative nature of our underwriting. Okay, now I'll pass it over to Hemel.
All right, thank you. So when it comes to, I'll speak about the debt first, right? Because in this volatile environment, to have the right debt, not only from an interest rate and terms and how many years fixed versus floating, but also to understand what level of flexibility that it affords. Because we all know that Federal Reserve, pushing rates to curb down inflation. At some point, whether it's 12 months from now, 18 months, 2 years, 3 years from now, there would be some level of reversion from the Fed to pump up the economy again. That's how the market cycles have worked in the last 9 to 10 cycles, and that's how it will work this time around. So our job was to find and negotiate the most flexible debt that we could have for this one, and we've successfully done that. The firm that we are partnering with is a balance sheet lender, so they're a REIT. They have the actual dollars. They're not borrowing it or anything from anyone, like most debt funds do, or investor equity that actually have them on the balance sheet. So we are ready to execute and close by the end of the year, which is number one in this volatile environment. Second thing is they allowed us to have only a 6 months lockout period. So most debt has a prepay penalty, even residential debt. Sometimes when you lock in a rate, they have prepay penalty. Most of the agency debt or Fannie Mae or Freddie Mac debt in the commercial space comes in with 5 years or 7 years or 10 years prepay penalty with a step down or any sort of element. So allows you to really get locked in for several years, which we didn't want to do. So this 6 months lock-in period allows us to, on month 7, if Federal Reserve reverses the interest rate, we can refinance out of this loan into something bigger or more stabilized or longer term loan, or sell the asset without any prepay penalty to be paid, which is amazing. The debt itself is floating, but allows us to buy cap rate insurance. So it puts us at 8% fixed debt with the purchase of the cap rate insurance. We'll be buying that for 2 years initially. And if we need to extend that over a period of time, we can buy it on an annual basis. We have 5 years of interest only period and 5 years term with the debt. So it allows us to navigate very successfully, increase the rents as we are looking into, and navigate this cycle, the market cycle that we are in, without any sort of refinancing options or having to take down a new debt or anything of that sort. So what that does with if you look at the sources and uses, we've got the senior loan at $16 million. Our equity partners and us are coming up with the rest, with the 11 million, and that goes towards the acquisition, the closing costs, the reserves. We're getting it really well capitalized with 6 months of interest given to the lender upfront. So allows us to really execute on our business plan, having not to worry about any sort of mortgage payments or anything of that sort, plus renovation budget and working capital. All that combined, it makes it that 26 million overall purchase price. And an exit, we have a 3-year exit plan as of now, but to Sujata's point earlier, we might be looking at exiting a little later based on the macroeconomic condition, or even if things go back to a compressed cap rate, it could allow us to refinance this asset. This is a very straightforward hold from an operational standpoint, and it allows us to enjoy the returns for a long-term basis, build the equity for a long-term basis for us and our investors. So as of now, with the 36-month exit, with a 5.25 exit cap rate, which is very conservative in the Greenville area, Class A assets before this tsunami of federal increases, it used to be at 3 cap. So 5.25 is really, really conservative based on that. We're looking at an estimated value of 34 million based on the NOI at 3 years, and selling those each unit at 354,000. The great thing about build-to-rent community is an added flexibility that is not available in the apartment communities, which is each of these houses are single deeded houses. So each of these townhomes can be sold separately if we need to. That's not the plan, but that gives us an added flexibility. And that's why a lot of big hedge funds like Blackstone really love this asset class more than anything else. Go to the next slide. Yeah, I won't go into the 3-year cash flow model, but we really want to be transparent on how we assume where the expenses go based on all our underwriting, all our due diligence. So I would encourage everyone to look at this. Have any questions, please ask Sujata or myself, and we'll be happy to answer those.
Okay, thank you, Hamel. I will go over the investor returns. So the first opportunity to invest is with Class A returns. This is preferred equity. And what that means is that the preferred return will be 10%. And that comes before the common equity, which we'll go over next. That means that the average cash on cash return is going to be 10%. The average annual return is going to be 10%. There is no participation in upside from proceeds from sale in this case. But what you do get is you get a higher place in the capital stack, and you get to receive that preferred return of 10% every year. So if you're the type of investor that's looking for to create a cash flow portfolio, this might be a good fit for you. If you are risk averse, this may be a good fit for you if you want to be higher up in the capital stack. And most of our investors will probably come in at the Class B level. And so that's common equity plus a preferred return. So in that case, there'll be a 7% preferred return. And our fund, the Luxe Capital Fund, there will then be a 90% after the preferred return will go to limited partners in the Luxe Capital Fund, and 10% will go to Luxe. That equates to an average cash on cash return of 5 to 7% and an average annual return of 20 to 22% over 3 to 5 years. And so if you have time and you want to go back, this is an example of what that would look like if you invested $75,000 over this is going to be I believe, a 3-year time horizon. Okay, so here's the sensitivity analysis. So as you can see, this is where we are with our pro forma. So we're right in that 18.5 IRR and 1.62 equity multiple over 3 years. That is when we would, we're just basing these projections on 3 years. And so we're assuming a 5.25% exit cap rate, and that gets us to here. So what the sensitivity analysis does, it allows us to see how the deal is going to perform if things work out more in our favor or less in our favor. So if we're able to sell at a lower cap rate and still exit in year 3, then we'll receive an IRR of more like 21%. If we are able to sell at a 5.5 cap, it'll look more like a 16%. And so you can take some time to review this page and just get a sense of what the deal might look like if it goes longer, or if the market is softer or more advantageous for us. Okay, now we'll go over our team. So I'm Sujatha Sham. I'm the founder and CEO of Luxe Capital Investment Group. I've been investing in real estate since 2010. I started out working for institutional equity partners, so large banks and financial institutions. I was a financial analyst and an underwriter for them. So underwriting projects really much like this one. And so that institutional experience has been really beneficial as I've moved into the private placement sphere, where instead of institutional investors, we're dealing with individual investors and helping individual investors build wealth in this sophisticated way using these very attractive deals on a risk-adjusted basis. I live in Portland, Oregon, and I just love this space. I love what it can do for people and their ability to build wealth, build passive income, and retire earlier, work less, have options in their life. And that's why I love what I do. And now, Hemel, would you please introduce your team?
Yeah, absolutely. So Exponential Equity, we are a team of 13 people based out of Charlotte, North Carolina, and focused across multiple asset classes and multiple asset cycles within the Carolinas market. So we have a land division, we have ground up construction, 85 million of ground up construction going on in the Charlotte MSA, and we own about 1,000 multifamily units, most of them in the Carolinas, which is about 2 to 2.5 hours within this asset's territory. So we are vertically integrated as well and manage the property, some of the assets. We do construction management and essentially, understand the economics of these sub-markets really well for allowing us to develop the relationships with brokers, vendors, other operators, the local economic development companies, the politicians, the council, the communities, etc., to build viable communities around the place we call home. Yep, a little bit about our track record. So we have a little less than 1,000 units that I mentioned. Out of that, close to 500 are in the Greensboro, Winston-Salem, Gaffney. Gaffney is 20 minutes from this asset, a deal we recently purchased, very similar sized. And also we have 85 million in ground up construction that is including built to rent community. 35 minutes from this asset, a very similar size built to rent community that we are actually putting in the ground, the horizontal side of the construction right now. And that's why we are excited about this project, because we know what it'll take and what it'll cost, north of 200,000 for sure, to build that community. And so buying something at this cost basis really gets us excited.
Okay, great. So I will go over the next steps and then we will have any Q&A. So the first step is to go onto the investor portal, which you can access through any of the email communications that you received. If you haven't registered for an account, you can register for an account, view the deal room, and submit your soft reserve. The subscription documents will be available within the next 3 to 5 days. And if you haven't already verified your accreditation with me, we'll need to get that taken care of. So you can either do that through a letter from your CPA or another party that works with you, or you can use Verify Investor, which is a very simple process for most people. And once that happens, then you can wire your funds. As always, this deal is on a first come, first serve basis, and it's only open to accredited investors. So with that, we'll open up the floor for questions. I had one question come through. Hemel, maybe you could take this one. Could you explain the tax benefits that investors can expect if they were to invest, say, $100,000 for 2022?
Yeah, absolutely. So as you all know, or you may know, 100% bonus depreciation starts getting phased out from this year onward. So this would be the last year, then it becomes 80%, 60%, and then eventually phases out. So this allows you to take advantage of that. With a new construction project like this, the structural component, which is not the accelerated depreciation, is a lot more. The appliances and the carpets and the landscaping, which is the part that you can actually bring forward and accelerate the depreciation, is a little smaller component compared to a 60s or 70s asset with a lot of cast iron plumbing. So to that end, the actual depreciation amount expected is somewhere around 30% for an investor. So 100,000 invested right in this asset would yield a negative 30,000 K1 for your next year's tax return based on this year's K1.
Okay, thank you. And another question came through. How does this property compare to other apartments that are for rent in the market area?
Yeah, so the two closest comps that we've listed out, Towns at Converse and I think Longview Townhomes, those are the two that would be the most comparable. Most of these townhomes that are around this area are actually, one thing is they're clubbed together 4 or 6 at a time instead of this duplex, which gives you more privacy. You only have one wall that you're sharing, and then you have a level of privacy versus an attached set of townhomes. They also are very limited in amenities. So one of them doesn't have any amenities, while we have the walking trail and the dog park and the outdoor patio. And the second one does have a swimming pool, but again, nothing else. And then lastly, their construction, and we are builders ourselves, so we know this is just superior construction. This chic type of black on white appliances and lighting and the exterior for even the garage, etc. It's just superior construction than any of the other townhomes, but they do command significantly higher rents as of now than this unit. So that's what is the gap that we will be trying to close.
Okay, thanks. Another question came through. If the business plan is so straightforward, what unique value are we adding to this deal?
Yeah, that's a great question. So it is a straightforward business plan. We've done tons of 60s assets in the past, and compared to that, this is a walk on the beach, right, from an operational standpoint. However, we have a very strong property management team 20 minutes away in the asset that we recently purchased. So it allows us to have a level of scalability, have a level of resource mix that if the asset on one side gets full, then we can pass on the tenants to the other. Also, our incentive structure with our property management firm is a little different than most property management companies. We actually give our lease-up agents a higher bonus structure if they achieve that pro forma rents. Anything beyond that is a higher bonus for them. So we actually, every property that we've had, we've knocked it out of the park in terms of projection. So that's the value add component. But it's a beautiful asset that from day one, we can add value without doing much, or any average person would have been able to add value. So we'll be able to do more than that.
Okay, thanks. And the next question is, how did you meet the seller, and how did you compete to get this under contract?
Yeah, that's the exciting story that will go down in the books. But yeah, so typically these types of assets would go down with big brokerage firms like Cushman & Wakefield or Newmark or JLL. This local developer is only based in and develops asset in Spartanburg area, and they knew or were family friends with a very small boutique brokerage firm, and so they chose to list with a small boutique brokerage firm, and I think about 4 players saw this asset and bid on it, and so it wasn't extensively marketed, though it was a broker deal. And so we looked at it. We had just purchased an asset 20 minutes south or north of this asset, so we knew the demographics. We knew what we could do with such an asset, and the property management team in place. So our aggressive bid in terms of putting day one earnest money hard, allowed us to win the deal, even though, comparatively all the ranges from a price perspective were similar.
Okay, thanks. Last call for questions. All right. Well, thank you so much, everybody, for joining us on this Monday evening. Really great to meet you all. And if you have any questions about this deal, I look forward to talking with you about the deal and participating alongside of you in this really fantastic opportunity. It's just a deal that we're very excited about. It just is such a great blend of the multifamily recession resilient play combined with buying new construction single family homes. We just have limited construction risk because the place is already built. And we really just get to start cash flowing from day one and implement a pretty straightforward business plan. And very excited about the opportunity. So thank you so much for coming, and we will talk to you very soon. Thank you. Bye.